Okay, so learning objective number 6, we just talk about admission of a partner. Now, what about the opposite direction? The partners are leaving. So that's the withdrawal of the partner. So partners can voluntarily withdraw their interest, their equity in the firm. For example, partner's personal life has changed, right? Partner decided to quit to be accountant, wants to be a Hollywood movie star, right? So in that case, the partner voluntarily to sell their equity in the firm. Other times, partners are forced to sell their equity if they reach mandatory retirement age. So they have no option, even though they want to stay. But too bad, you reach the mandatory retirement age. If they died, if they did something horrible, jeopardized the reputation of the partnership, so they were being expelled, right? So withdrawal can be accomplished in two ways, right? So the first, the remaining partners can use their personal asset to pay for the leaving partner. Second, the payment to the leaving partner can come from the partnership asset. Okay, so I'm going to show you, it's going to be pretty clear. Okay, so I'm going to show you, maybe I will use this slide. Just give me 1 second. I'm going to insert a new slide. Okay, so let me suppose you have two partners, PA, P2, and you have a P3, three partners, right? This is their capital account, okay? This is their capital account. Capital account. Suppose the first partner has 100, the second partner has 200, and the last partner has 50. So in total, the partnership have a capital. So in total, the capital of the partnership is, you add those numbers together, right? 100 plus 200 plus 50. So that is 350. Okay, so the total capital of the partnership is 350. Okay. Let's assume, oops. Let's assume the balance sheet, right? The balance sheet. The balance sheet of this partnership. So let's say you have a cash of 500. So your asset is 500. Your liability, the money you borrowed from bank, is 150. And your partnership equity your partnership equity is 350. So the total liability plus partnership's equity is 500. So, right, your total asset is 500 because you have cash 500, and you have $150 liability, and you have 350 the partnership's equity. So you together liability and equity is also 500 equals to the asset 500. So this is the scenario. Okay. So the first thing, this guy, P3. Okay, let's say P3, this one wants to leave. This is person wants to leave. Okay. Well, he has a capital balance of $50. He wants to get the money back, right? So the idea is who is going to pay for it, right? Who is going to pay for it? So the first approach, that this partner one and partner two use their personal money to pay for it. Okay. So suppose, partner one and partner two, okay, they each contribute. They will contribute evenly. So then partner one will use $25, and the partner two will also use $25. Together, that's the $50. So then they use that money to give it to partner three. Okay, so that's what it look like. Okay, so P1 will increase by 25 because they make more contribution. So they contribute $25 to the partnership, and P2 also contribute $25 to the partnership. So in total, that new contribution is 50, and that 50 is used to pay P3. So now P3 is happy to leave. Okay, so now let's take a look at P1, right? P1 has 125. P2 has 225, right? So P1 and T2, the remaining partners, their capital balance increased, right? Both increased. But the total doesn't change. So if you add 125 plus 225, and the P3 is 0, right? P3 is 0, it's gone. These two together is also 350. So in this approach, the total capital of the partnership doesn't change, right? Prior to the leaving of P3, the three partners add up to be $350. After P3 left, the two partners, P1 and P2, add up to be 350. So the total capital balance doesn't change. However, the individual partner, P1 and P2, their capital balance increased. Right? So this is one approach, right? This is one approach. Okay. Now let's think about the second approach. We're going to use a different color, green color. So this is the second approach. I'm going to use green color. The second approach is that money doesn't come from the P1 or P2. Okay, so P1 is still 100, no new contribution. P2 is still 200. And P3, this $50, where is that coming from? So this time, I'm going to use this cash. So this $500 cash belong to the partnership, right? So I'm going to use $50 from here to settle P3. So I'm going to use the partnership's money to pay P3. So now P3 is gone. Okay. So my cash become 450, right? Because I used $50 cash. So that cash balance goes down from 500 to 450. Right? And now this one is gone. So what's the equity left? The equity left is only P1 and P2. P1 has 100 unchanged. P2 has 200 unchanged. Together, P1 and P2, so that is 300. Okay. So my capital balance now with only the two partners are not 350 anymore. It's 300. Okay. So liability is 150. This is unchanged. Plus equity is 300. So my total liability and equity, this is 450. Okay, you can see when I use the second approach, the total capital balance of partnership decreased. The total asset of the partnership decreased. However, for the existing P1 and P2, their capital balance remain unchanged. Okay, does this make sense? Give me a sum up if you understand this. 1, 2, 3. Give me a sum up. If you have no problem, you understand everything.
I didn't understand, Professor. Can you repeat?
Yeah. How about Jules and
Thank you.
Sebastian?
I would also like that recap.
Okay, so tell me which part are you confused?
For me, it's from the beginning. For the second approach.
The second approach? Okay. So for the second approach, so you need to give the partner P3 $50, right? And the bank of the partnership have $500. So you take $50 from the bank of the partnership to pay the P3 and let him go. Because you use the $50 from the partnership, so the cash dropped from 500 to 450. Your asset dropped from 500 to 450. Okay? And your total partner's equity now only have P1 and P2 left. And P1's capital balance is 100, P2's capital balance is 200. So together now, the total capital balance is 300. Okay? So now you can see the balance sheet is still balanced because your asset is 450. Your total liability and the equity is also 450.
Okay.
Does that make sense?
Yes.
Okay. Sebastian, does that make sense?
Yes, Professor.
Okay. So now with this, all the other things will be much easier to understand. Okay. So basically, this slides just using the text to explain what we just did. Okay. So here, a payment from partner's personal asset. This is the situation. P1 and P2 each contribute $25. Okay. A personal transaction between partners. The payment is from remaining partners' personal asset. So P1 and P2, they each come up with $25. Partnership assets are not involved, and the total capital of partnership does not change. Okay, so the total cash 500, is there, not used, and the total capital balance is also 500, 350, not used, not changed. The second part, and then in the partnership, only the transfer of the partnership interest is recorded. So the departing partner's equity is eliminated. So P3 is gone. Remaining partner's equity increased by the same amount. So P3, the equity 50 is gone, but P1 and P2 together, their equity increased by 50. The amount is split between the remaining parties on the same basis, right? So in my example, that 50 is evenly split. So 25 for P1, 25 for P2. This is the situation that the payment from partnership asset. This is the situation that instead of the remaining partners come up with the $25 each, this is to use the partnership cash to pay him out. Okay. So the partnership pay assets paid $50 to withdraw P3's interest. Okay, so the net asset now is not 500, it's 450, right? And the total partner's equity was 350, now it's only 300. So both partnerships net asset and total partner's equity decrease. So complications will occur when the amount paid differ from the withdrawing partner's capital balance. In my example, the partner leaving is P3, the balance is $50, and we pay him exactly $50, right? But the complication will occur if I pay him 55, 45, there will be the bonus involved, right? There will be the bonus either direction involved. Okay, see, that's why I want to do this problem together and then go back to go through those slides. I hope that makes more sense, because if you don't do this first, those slides will be crazy. You won't understand it at all, right? So are we okay with this?
So, Professor, so in the second approach, the owner's equity increased by 50?
No, it doesn't change. Under the second approach, P1
Yes.
is 100, doesn't change, right? P2 is 200, doesn't change.
But
So
what about P3?
P3 is gone because P3 is the leading partner.
Is a leaving partner. Oh.
So he does not belong to the partnership anymore, right? Because he withdraw all his capital balance, it's gone. Yeah.
And can you explain the first approach again, just so I can tell the difference?
The first approach. The first approach is that you don't use the cash from the 500. Instead, P1 will contribute a new $25. P2 will contribute a new $25. And they use this together. This 25, this is the new capital 50. They give that $50 to P3 and P3 is gone.
Oh.
Yeah.
So
now,
in the first approach, the owner equity decreases while the balance statement or the balance sheet is the same. And the second one is the opposite.
Yeah, exactly. So for the first approach, the balance sheet doesn't change, right? But you only have two partners and each partner's capital balance increased. For the second approach, the remaining partner's capital balance doesn't change, but your balance sheet has changed. Asset and equity both decreased.
Yes, I understand now.
Yeah, okay. Anyone else have any question? Okay, so if you understand everything, give me a sum up. 1, 2, 3. Give me a sum up. Okay, good. Bonus to withdrawing partner. Okay, so if you give the leading partner more money, right? That extra money would be the bonus to the withdrawing partner. If you give less money to the leading partner, right? The difference would be the bonus to the remaining partner. Okay, you see, right? The fair value is the capital balance of the leading partner. If you give them more, you are giving them a bonus. If you give them less, right? So the money saving is actually a bonus to the remaining partner. Okay. So this is an example of calculating the bonus. Okay, so we can work on this. So let's work on this. We still have 12 minutes, okay? So let's work on this problem. So the partner, there are 3 partners. The capital balance for Roman is 50,000. For Sand is 30,000. For Turk is 20,000. And the partner's profit ratio, Roman, Sand, Turk, 3 versus 2 versus 1. And the Turk retires and is paid scenario 1, 25,000, scenario 2, 16,000. So please calculate the amount of the bonus and the bonus to who, right? So we have 12 minutes. Let's work on this one.
In scenario 1, do we use the first approach or the second approach?
This one, let's see.
For scenario 1, I mean.
You don't need any approach because you know his balance is 20,000, right?
Yes.
And you pay them 25,000. So what is the amount of bonus to who, right? It's very simple. Don't overthink.
Oh, okay,
Yeah.
okay.
Yeah.
So for the first scenario, it's the bonus is for Turk because he paid 20,000, and then when he leaves, he gets an extra 5,000.
Yes, good. So that's the bonus to Turk, right?
Yes.
And what about the second scenario?
For the second scenario, it's 2,000 bonus for Roman and 2,000 bonus for Sand, which equals $4,000. That's the difference that he is paid. So yeah.
Yeah, and in that case, you just split evenly, right? So you are saying the bonus is 4,000 because Turk has a capital balance of 20,000, right? But he only takes 16,000, leaving the 4,000 to be allocated between Roman and Sand. But does that has to be an even share, even split? The idea is the profit
no,
ratio,
because
right?
it's 3-2. Yeah,
That's
I forgot
3-2,
about the
right?
profit ratio.
3-2. So if you have a 3-2,
Yeah.
so that means 60 for Roman and 40 for
14.
Sand. Yeah. Okay, it's very good. I think you got it, Hassan. Yeah. What about the other students?